And thank you all for coming out today to the Dan Foss Fireside Chat event. It seems to be an annual thing, so we hope it'll continue. Gonna pass it up to Jim Sarney and we'll do the biography.
Thank you, Ryan. Well, good afternoon, everybody, and on behalf of So turning it off isn't helping.
Should I turn it off?
No, I turned mine off. Should I?
Oh, you turn it
Okay. Good. Hopefully it's not really,
I wonder if. Okay.
Can you hear in the back? Yeah. Can you hear my comments? Oh, I'm sorry about that.
Well, maybe we'll try it one more time. It seems to be working so far.
All right.
So,
Did you say I yield further gonna type?
No, I said that another night, like last night, now be the one that's typing.
So on behalf of CFALA, I want to welcome all of you here. I guess that we must have done something right last time because we got asked to come back. So it's a pleasure to be here. And I have the very distinct honor and pleasure of engaging a man who really needs no introduction in a conversation here. And Dan and I have had a few conversations in preparing for this, and it's been an absolute delight. But as I said, he really needs no introduction, but I have just a few things to tell you about Dan, for those of you who might not be familiar with all of his accomplishments. And if I read all of them, you can imagine it would be a list that would keep us here all afternoon. So I'm going to try to highlight a few of those things, and then we will go over some housekeeping rules and let you know what we're trying, the way that we want to plan the afternoon here, and then we will plan to wrap up the meeting, the formal meeting, by 1:30 today. Dan has over 55 years of experience in the investment industry, and he's been with Loomis Sayles for a large part of that, since 1976, if my notes are correct. So that puts you there 40 years, 40 years. So he's obviously seen a lot, and we're going to have the benefit of hearing that. He's vice chairman of the firm, and along with a couple of his colleagues, run the firm's flagship Loomis Sayles Bond Fund, which at last count, I might be off, was somewhere in excess of 17 billion.
Correct.
So, and counting, right? Maybe a little bit less after
the market.
by the day.
It might be less, it might be more. Today it's a whole lot more, but the same bonds and prices.
He also, as you can imagine, is part of the team that oversees some of the other firms and the firm's other assets. In terms of some of his accomplishments in 2012, he received both the Institutional Investor Money Management Lifetime Achievement Award and also the Lipper Excellence in Investing Award. And then in the year 2000, he was named to the Fixed Income Analysts Society's Hall of Fame in recognition of his many lifetime accomplishments. But I have to tell you, putting all these great things aside, and this list goes on, that in talking to Dan a couple of days ago, among his most, I think, endearing qualities is his humility. Despite all of his accomplishments and all his success, is how he remains very humble today. And he shared with me a story that I will just tell you that I think speaks to that. And Dan told me that among the many things that he's accomplished, mentioned the achievements, there's one that really ranks very highly up there that he's the most proud of. And that was 3 years ago. Dan is very involved, and he's a regular speaker at the Milwaukee Society of Financial Analysts. And goes back every year and speaks there. He's a graduate of Marquette, which is the main university. And in 3 years ago, in the very same room that 50 years prior to that day, he was part of a leadership team that was discussing becoming the group of investors in Milwaukee becoming a branch, as you called it, of the Financial Analysts Federation, which I'm not sure how many of you even know what remember the Financial Analyst Federation, but those of us that have been around for 150 years do remember that. But it was in that very same room and almost to the day, 50 years prior to that, that he moved forward and were part of the team that really created the Milwaukee Society. And they awarded him the Lifetime Achievement Award from the Society. And so I think that really speaks to the humility and the good all-around man that you are. We're just so happy to have you here.
Well, thank you. I'm very proud of you. And I'm even more humble after the last couple of years.
I think we all are. So without further ado, let me just say that what we will do is I'm gonna lead Dan in a conversation, not that he needs to be led, and I have a few questions and we'll see where this conversation goes. And we will converse until a little bit after 1 o'clock. And then each of you've seen that there are some note cards on the tables, and I would ask that as you have questions come to mind, if you want to write your questions down, and Laura's standing in the back there, and she will come around and collect them and be bringing them to me. And then I will draw our conversation to somewhat of a close of around 10 after 1, 1:15, and then we'll start going through some of your questions, and we will draw the meeting to a close at about 1:25 for our 1:30 adjournment. Okay with you? Okay.
Great.
So, Dan, when I talked to you, one of the things that we were talking about is clearly this year, as by anybody's standards, has started off with a bang. And, the markets globally, not only the stock markets, but the bond markets are clearly in a state of disarray. And we're having a good day today. Yesterday was not such a good day, and who knows what it'll be tomorrow. But clearly, there is a lot of volatility. And one of the things that we had talked about is I was saying that we're all reading the various publications and watching CNBC and Bloomberg and things, and today's markets are being compared to 2008, to earlier years. And when we were talking about that, you stopped and you said, no. This market is exactly like it was in 73, 74. And one of the other things that you said was that you just knew that in October of 74, that if that was the beginning of that things had bottomed and it was over. And it made me think that that you are a tremendous intuitive investor, and intuition is a big part, I think, of what your success has been. And if you fast forward to today, in a world that we live in where the availability and access to information is so pervasive and so widespread, there's a tendency for all of us to always wait for that next piece of news to come out, because maybe there'll be some information in that next soundbite that will be helpful. And when one combines that with time horizons, investor time horizons, which seem to be getting shorter and shorter and shorter, it seems to be a different world, and that art of intuitive decision-making, I think, is gradually losing its steam. So Dan, I wondered if you could maybe start off by talking about, first of all, do you agree with that? And if you do, how do we navigate in a world where the train seems to be headed in that direction?
Well, in order to help understand my answer here, I'd like to show of hands of how many people in the room are familiar with Myers-Briggs.
Myers-Briggs.
All right. If you're not, talk to one of those who raised their hands later. What it is that it's a temperament test. It's commonly used in the HR departments and what have you. And it's aimed at preferences. And the theory being that if you're doing something all day long, you'd be better off if it was something you would prefer to do, as opposed to not prefer to do. It does not apply in the evening for those who are men in the group, and you go home and there's a list of chores that your wife has drawn. That is not necessarily playing to your preference. It is something that plays to the preferences of some people. In Myers-Briggs terminology, they would tend to be ISTP or J. And other people would be an E, extrovert, strong N, intuitive. Normally, if they're male, they're a gender-adjusted F, which is the only one you would gender adjust for. In other words, they're near the middle, or somewhere in the middle, and they tend to be J's. Now, what does this all mean? If you get an extreme temperament, which I am, the person who looked at the results said, "Oh my God, you're married?" Okay, I'm at one extreme. And when you're at an extreme, and as you age, if you're lucky enough to age, you find out where the soft spots are. And so you become, in this example, an enormous consumer of research in my case. I want to read a book, but I'm always reading research. And as the investment management business has progressed, something else came into play in the early 1960s, and it's called the quantitative approach. Back in the days of the FAF, Jack Traynor was a quant. I, of all people, was one of the 12 people, the famous or infamous, more accurate, group of 12 at the Atlantic Tavern, in Chicago, behind the Board of Trade, where the early quant people would gather. The ringleader was the assistant treasurer at the University of Chicago. And a lot of people who subsequently became quite famous on that side were there. My job was to pour the beer. As the computer expanded and took over the process of measuring things and developing new products, this is where the portfolio insurance came from. They, developed, and this seemed a whole lot better. And a lot of the early thing was not done in the securities markets. It was right over at the Board of Trade, where a lot of commodity traders latched onto this. One member was over there. And it seemed to be very successful. And it relies, and here comes the fundamental weakness. Now, we're big, in full disclosure, Loomis has a very large quant operation. We use it in many, many, many ways. The one thing we have learned about using the historical pattern to say, here are your probabilities, are that it leads you astray. Because there will be fundamental settings underneath that change. It might change geopolitically, and they certainly change depending on the market. Certainly within securities markets, they change because from time to time, from era to era, from day to day, from hour to hour, the underlying of a market, the liquidity changes. And so, can you use these things effectively? Yes, you can. Are they a tremendous help? Yes, they are. Are they good at forecasting? No, they're not. Not that they aren't helpful to you, but the markets in general, whether it be for commodities, securities, or potatoes, is not something that's 100% physical. You can measure it, but you're looking back and measuring what people do. And you're also dealing from a very incomplete set of data. The data is derived so far from fairly well-developed markets looking back in a different environment. And so that's a limitation. So there's no such thing as a self-driving portfolio. And I can go on this thing, but I'll just point out the fundamental flaw that normally upsets the apple carts. If you try to do it completely mechanically, the underlying flaw in there is the basic market liquidity changes, and all of a sudden the relationships change. Why do credit default swaps do poorly when they should be going gangbusters? Well, where's the market? Well, it's very liquid, right? No, it was very liquid. Today it's not. Tomorrow it's not. And that's what you have to look out for. Am I an intuitive? Yeah, I'm an intuitive to the point it drives Rosemary crazy. In case of opposites attracting, we prove it on that. Luckily, we have enough. Was 73, 74, I didn't really know because I was intuitive with market value. I knew it because Commercial Union was forced to sell all their equities. Now, I will grant you, everybody else thought it was nuts. They didn't think it was over. I thought it was over because you had a market clearing event. It's the only one I can say that was like that. The Tuesday morning after 87, you knew it was over, but there were other reasons for that. And I've yet to experience a market that I was able to tell you in advance what it was and what's coming. You can experience what's happening, but you can't necessarily say what's going to happen. And that upsets the clients no way to say that. But it's reality. What you can say is you can say, okay, I'm here now. Jim, you sit down, you look at this and you say, okay, here's where I am. Here's the structure of it. In the case of a fixed income fund, I do it with equities too. Here's the structure of the cash flows. Here are the possibilities, or in some cases, probabilities that those cash flows will happen. Ability to pay, or ability of the issuer to bring it back, or maybe day will come without daylight or something. And so you can structure that. It's not a surefire. It's not, if you do a cash flow match, that is not surefire. If you do a liability match, that's fairly high odds, but it's not surefire. And then once you move off into the geopolitical, once you get outside of your base currency, and we have a lot of accounts that are multi-currency, then you don't know because you're dynamic, and this is where the intuitives come into play. Your dynamic is a geopolitical dynamic. And the underlying markets are just there to complicate it and make your day sort of miserable and offer you opportunity once in a while. And the disconnect between managing money this way, it works wonderfully well if you know how much you got. That's it. They're not going to take it out. They're not going to add to it. Great. Open-ended mutual funds don't fit that pattern. ETFs don't fit that pattern. But where the portfolio itself is not subject, within reason, or even unreason, to unexpected cash flows, particularly negative ones, then you can use your intuition. Then you can say, all right, I'm going to run all the quant numbers to see the stuff I've missed in my own thinking. Where am I outside of 3 standard deviations based on the past? And what's happening today? What happens today in the Middle East, Eastern Europe, and the South China Sea is a whole lot more important than past correlations. And that's a different way of looking at things. And the problem you run into, the problem we have, the problem I have, is you say, okay, that's all well and good, nice speech, thanks, David. So here are the following specialists. No, you need them, but somebody, it says buy or sell, has to synthesize. And the problem with the specialists, of which we have many, and I'm all in favor of and I push for, is that they're likely to not see the big picture. And so this is what makes it fun. This is what makes it unpredictable. I think over time, it's a self-serving comment, the more of that you have, I'll wrap it up by saying I was asked at one point, actually by one of my daughters who's a professor down at Princeton, and she said, Dad, put it in English in one sentence, would you? And she's a semiotician. She can put it in English in one book. I said, common sense, well informed, is good intuition. Now for my next speech.
So you have, I think it's hard to have a conversation about the markets these days, whether one is an equity or a bond investor, without bringing up the subject or the topic, as you have several times throughout here. You've used the word market or liquidity.
Oh, yeah.
And clearly liquidity is a consideration, constraint, whatever you want to call it, with which we all have to deal in our markets. And Dan, I would be particularly interested in hearing your perspective on that, for lots of reasons, not the least of which is the fact that you represent an entity that is a large player of mutual funds. Did you mention some ETFs?
We don't learn.
You don't, but certainly mutual funds. But ETFs are clearly becoming a much more of a force than they ever have been. And the growth of ETFs has just gotten to be exponential. And some people are saying that these vehicles are enhancers of liquidity, and some people are saying the fact that, or the opposite, that they are really destroying liquidity. So I'd love to hear if maybe you could comment on just liquidity in general, and do you see mutual funds and ETFs being a potential issue down the line as liquidity continues to become more of a constraint?
I certainly do see it becoming a potential issue. But let's go back to just the base liquidity in the markets. I can't speak too authoritatively on the stock market liquidity, nor can anybody else in the company. There are so many factors influencing it. It is not what it was. That's a fair statement. There have been a lot of synthetic additions that have been very helpful. But it's not what it was. In both stocks and bonds, the middle of the market is not as big as it was. By the middle of the market, the bond market, I'm referring to the dealers and their ability to carry inventory. If you use the analogy of saying, well, what about Macy's, Neiman Marcus, and so forth, they used to carry 35 men's shirts, 16 and a half, 33. Okay, what if they didn't carry any, or what if they carried only one or two? But they said, when you asked where they went, they said, hang on, Jim, listen, give us a week and we'll find some. That's sort of a silly way to look at what's happening in the bond market, in the middle of the market. And yet the market makers have an obligation implied. You don't have to, but implied. Very strong implication if you're a treasury dealer. But not anywhere else. To make a market, present a market. They will present a quote. And you don't need them to do that. Just, go find a matrix and plug things in. But the function of making the market in the corporate fixed income market, which is where it's most visible, in the change relative to say 10 years ago, that function is being performed by people that have no obligation whatsoever to maintain the market because it's not in their charter. It was in the charter, it is in the charter of JP Morgan, and et cetera. But they commit less capital to it. And they have much tighter constraints on it. By the time you get to high yield, the constraints are just about like that. They cannot finish a day, the high yield traders, unless they're flat. If they finish it, they're not flat, they'll be flat on their back in the street. And so the proprietary trading has gone out of the market, but it's come back in, less money in the hands. In fact, the very proprietary traders that were at some of the major banks have moved across the street, named it after themselves, and they run the hedge fund, and they perform a gray market or auxiliary market. They like to say expanded market function. But they have no obligation to do anything other than make money for their investors. They're good people, they're not bad people, they're good people. A lot of them have managed to go broke here over the last year and a half because JP never got a market. Who would give a collateral call to JP Morgan? They will give a collateral call to Tom, Dick, and Harry's hedge fund in a hurry. And JP would be quite a bit more levered. Tom, Dick, and Harry can lever maybe 4 times, and that's pretty aggressive. So that's what's happened in the middle of the market there. Now, the dealers that were there in the U.S. market that didn't live in the U.S., the corporate entity didn't live in the U.S., they're leaving. And the dealers that were there in Europe that didn't live within the European Union, within the common currency, they're leaving. The structure of the firms, the dealer firms, is changing. And it is going back to agency functions insofar as the market is going. Just as it was in the 1970s. There weren't inventories in the 1970s. Interest rates were rising and the dealers were partnerships. They couldn't carry that much. And the market adapted to it. Was it a good market for the issuers of corporate debt? No. Who filled in as the investors, well, the life insurance companies. What was the nature of the normal corporate financing was a private placement with rigid contracts drawn. And the norm was a payback over 20 years, 10 years, 12 years. This is where the equipment trust going. Are we headed back that way? I don't think so. Are we partially going back that way? Yes, we are. But we're doing it in a period where the base rate of interest is so low. You know, the major pressure on the Fed to get that short rate up is coming from their own advisors who represent the banking community. How do you run a savings bank in Boston, Massachusetts if you can't pay interest? How do you make loans? You know, you say, oh, the world's awash in money. No, don't talk to any of the merchants in Wellesley, Mass. They strongly disagree. The most rapidly growing banks around there are only a couple, and they're small. And they're opening offices in downtown. Who would have thought? So, I don't know how we got off on this topic, but this market liquidity thing is a tremendous advantage to fixed pools of capital or controlled pools of capital. If you are a corporate defined benefit plan in the current setting, you're back, and a lot of them are doing this, at least our own clients are. You're saying, hey, this doesn't work now unless stocks go back to 21 or 2200. And Dan, can't you just get us, 30-year solid investment grade, 30-year non-callable, and we'll add to the liability. No, I can't do that. Well, can you get stocks to go to 2400? Wish I could. Our business would go. Can't do that. Okay, let's forget the whole idea then, and let's go do something else with their money. That doesn't sound real good to me until we can do a discussion of what else it is we do. But that is what's happening now. You say, okay, that's all well and good. So what are you going to buy? Oh, well, let's do a cash flow match. That's actually a very good idea. For that to work, you've got to, forget single A or triple B plus. You're talking double B minus and single B. Oh no, we can't do that. Some will say, well, yes, we can do that. And that is happening right now. At the end of the business, it's really amazing. You have transfer of high yield coming out of retail, so to speak, or the open-ended vehicles, going into the institutional funds. But not the fund, the individual, because they can control and take advantage. They can't control liquidity, but they can take advantage of the lack of liquidity. The old saying of bringing a bid to an illiquid market really, really works. And this has been noticed offshore, and a lot of the Asian money coming in is doing the same thing. Either by using US managers or overnight doing it themselves.
So Dan, let me ask you this. Having said all that, how much do you worry about that liquidity event where you come in one day or big player X, Y, Z comes in one day, and it's not just one day, but it's 2 days, it's 3 days, it's 4 days of outflows, given the backdrop of what you just described?
I do worry about it, not with the intensity that I worried raising 6 kids, 6 grandchildren, and 1 great-grandson. I do worry about it. Plan for it. We only can plan up to a point. It's much, much easier to plan again in the separate accounts than it is in mutual funds. In the mutual funds, we built up 25% reserves. That was a dumb idea. And, just brought the dividend down. It allowed me to get an extra half hour of sleep. And it was proven to be a pretty good idea after all, for the lag. And now you have reserves, you can commit into this market, which is clearly a buyer's market. Today's not today if you want to sell it. Is there going to be an event? I don't know. Well, wouldn't the Fed be there to save us? Well, their normal tool of announcing or cutting interest rates, but the market with liquidity can't cut interest rates very much. You can, if we were having this discussion tomorrow, it would be a very different discussion by this time. And I have no idea what they're going to say or do. If it were up to me, I would come out with calming words and pray. But direct answer, yes, I do worry about it. There are too many products that provide liquidity for an illiquid asset class. And some of them, a lot of them, depend on synthetics of one type or another. In the synthetics, this was proven in 1987. That was a good reminder. Don't always work.
So let's turn it to, before we start turning to our questions from others, because I like to leave things on a positive, constructive note. We've talked about what the constraints are and what the challenges are. How about the opportunities? And I want to ask it as a fixed income investor myself, and there are a number of my colleagues here from Hagen Wiggle. Dan, where do you see the opportunities? And if you could maybe address a sort of corollary issue to that, which is that when one looks at a typical bond portfolio today, Many people would say, this isn't a bond portfolio. It is full of things that are not just bonds, or bonds in disguise, as I would call them. So one, where are the opportunities, and how I would suggest that I think we will continue to see things moving in the direction of greater diversity and the walls between the asset classes increasingly coming down and being less significant than they once were.
Yeah.
So a stock fund becomes a bond fund, and a bond fund becomes a stock fund, and at the end of the day, we're back to where we were 40 plus years ago with a balanced portfolio. So my question to you is, how do you respond to that?
Well, I agree with you. I think you just described perfectly the opportunities today, insofar as the markets go. You have two quasi-extremes. You have the one that's most notable is you've had an individual spike in the US dollar that's been joined by a group spike in the 5 major reserve currencies. That joining up started last summer. The spike in the dollar started in the summer of 2014. Past history with spikes, and here's where the quants will come in. They'll say, well, gee, Dan, look at this thing. The odds are now 99 to 1 that the spike will be over. And I say, yeah, that's true. When? And from what level? Yeah, well, we can't quite tell. Yeah, oh, okay. So thanks for the info. But I agree that it is probably unsustainable, but it's driven by geopolitical events that's forcing money out of Southeast Asia and government policy that's forcing it out of Japan, and it's all coming into the US dollar and the euro. And quite interesting, complicated life in Japan is going into Japan. So that kind of event. So that's a tough one to call, but you have to acknowledge that, okay, it's there. The other one is on the valuation side, relative, and relative, subject to some narrowing today, is that corporate spreads are pretty wide to treasuries in the investment grade area. But the base rate of interest is low on treasuries. So on an absolute basis, are yields high in investment grade corporates in general? No, they're not. Are spreads wide? Yes, they are. What about high yield? Well, which is a difficult asset class to call an asset class because it's so scattered. Nonetheless, the absolute spreads, and there's a lot of covariance because of the outflows from the mutual funds. And now, because of the inflows coming on the separate accounts, particularly of all people, the corporate defined benefit plans, who used to be the liability managers. So you have that transfer going on, and you look at the absolute level of yields, and you look at what your guess is on the credit cycle, which our guess is we're in the third quartile. You have to be more careful. And the odds that might back up a bit, which are now high if the Fed reverses. And you say, well, okay, allowing for all that stuff, on average, and let's treat energy, metals, and mining in a separate category, the extractive industries in a separate category. Take them out and look at the rest. Will you likely, and here again you go back to history, will you likely have a return that would justify after credit impairments, credit losses? An absolute investment in this environment? The answer is clearly yes, based on history. Where are we? Right back, the intuitives are always referring to the quants. Well, what about, let's mix in energy, metals, and mining. Okay, now it's tricky because you have a very, 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 very strong layer of things. It's just not the Saudis and Iran. You have all sorts of geopolitical influences that are negative and that are working against world growth, particularly production. And so you say, well, oh, okay, let's mix it in up to X amount. Now, let's put probabilities on that. Boy, how are you going to do that? You can. Does it lend itself to specific risk analysis? Yes, it does. And that's starting to play out now. You can see it easiest in the gas producers and some of the oil companies. Finally, the last few weeks, unfortunately, because it's getting hard to buy the easy ones to spot. And even the easy ones to spot, what if natural gas stays at 240, somewhere around there? Oh, okay, you made some good investments. What if it goes back to 160? Oh, well, that's all right. They're hedged to 2021. What's the other side of that hedge? From who? Did you see the Supreme Court decision on the electric utilities in the paper this morning? I mean, that's a bummer. And if I were a gas producer, I'd be back looking at my hedges real carefully. So what I'm saying, Jim, is there are some unusual opportunities. They come because of some obvious problems that are affecting cash flows. Nonetheless, when running money where you don't have to worry about the money going out, you can really deal with this market. It's a good market to be a net buyer. If you have to look forward to money coming in, which always, the CFO is always happy with that, you say, okay, all right, how sure am I that's coming in? Well, they said they're going to add it in this quarter. Okay, what if the market that we're in gets creamed? Well, I suppose the pension committee and board might change their mind. You want to go 100% now? I actually would, but I'm old. People don't like to be nasty to old people. And that's exactly what I'm doing. I'm willing to take, in the case of a rational setting for the client, I'm not going to spend the money that might, but I'll take down the reserves in that account, and I'll put it in this market. And let's see what happens. But that's the intuitive response. In the meantime, the clients are going crazy. Did that help?
So what I'm hearing you say is you've got, among things I'm hearing you say is you've got sort of two strategies. You manage money in mutual funds very differently from the way that you manage money in a separate managed account.
Correct.
Clearly is
You have to.
yeah.
You have to, because the uncertainty of liquidity is so present in the markets. And liquidity is not what it was anyways. Our liquidity measure on the run investment grade corporates at this level of rates ought to be at least an 8 plus 9. It's a 5. Off the runs a 2. That is not a liquid market. And that's investment grade. So that's an on the run. What is on the run? Within the last 4 weeks, large issues somewhere in your park. That's not much of on the run. And because the middle of the market has gone squish, and the buy side has expanded tremendously. And so the sales punch through, the buys don't punch through. They're not able to buy much.
All right, Dan, you've done such a good job on these. These were easy.
I know that.
So now we're gonna turn
Now
to
comes the
we're
test.
gonna turn to the really intelligent questions here, coming from folks who are watching us up here. And I'm gonna give you an opportunity to get yourself into a little bit of trouble, because otherwise, how much fun would it be?
Hey, I've been a specialist.
So there's a question about the presidential election, and to what degree that we all should be concerned about the impact of that on the markets.
You know, I didn't get a chance to read David Brooks' comment. Today, I guess it was, or yesterday. And I wish I had, because his headline was great. It was something to the effect, somebody save us. I have in recent months spent a lot of time with our clients from Asia and a couple from Europe. But I was over in Taiwan, Hong Kong, and Taiwan, which is a little different mix than Singapore or Tokyo. And the commonality, and clients in Tokyo, the commonality is, man, what's going on? You know, what's going on? We don't understand this. Even the French don't understand. And it scares. It scares. Now, it scares me too. It scares me too. Now, I suppose from reading some history, you say, oh yeah, but look at times past. Okay, times past it was the US. Now it's the world. It scares, I would assume, they don't tell me, it scares the Fed. And part of this election rhetoric, part of the problem the Fed has to deal with is they're sort of left holding the bag. There have been some good articles on this. Fiscal policies inoperative. The ability to coalesce about most meaningful things in the Congress is inoperative. And furthermore, we're in an election year. It's very tough to come to the middle. I don't know him, although I guess I met him in his early days. Mike Bloomberg is now talking about running for president. Why? Because he sees a huge gap in the middle. In the US, always has been a bit towards the center, and then with the biases from Democrats or Republicans, left or right, whatever you want to call it. And now, as they pulled apart. It was sort of like the offensive line of the Patriots. They blocked out here and let everybody else rush in, except nobody's rushing into the middle politically. And I happen to think, my bet is that, and it's not just the U.S., Europe is also pulling apart a bit, but they have multiple parties. I would say there's one, this is an intuitive response, a growing chance that there will be a party of the middle, maybe. And you can argue this one. I'm on a board over at Harvard Kennedy School. And boy, you want to start an argument. You can walk in and say everything is really nice, this is good, and say now about the need for a third party, and then slip out of the room. It doesn't fit with our history. And it's hard to see an independent come through without a party. And if whoever it is has to move pretty quick or they won't be on the ballot. Is Mike Bloomberg going to do it? I don't know. Would a lot of people like to see him do it? Darn betcha. Where do they live? New York City.
No. No surprise.
Do they live in Des Moines or Milwaukee? I don't know. Although when I was in Milwaukee, not quite 2 weeks ago, some of your old friends, Jenny, would like to see that, believe it or not. That's how it is.
So let me ask you the inexact science question. Is the market, in your opinion, set up for how much of a disappointment do you think that there will be with a victory by one side or the other?
I don't know. I have thought a lot about that, Jim. My own guess is that if the president turns out to be somebody with a lot of history in politics, and, in government. People might rest for you. So if it's Hillary or Jeb, you would say, well, okay, now what if it's a governor, which is what Jeb is, but he's got the family. Then you look at it, I'm pronouncing it correctly, say Acacius or somebody like that. You say, well, okay, that's at that level. That's good. That's good background. What are the issues? They're all geopolitical. What are the risks? The risks are geopolitical. What's the major risk? That somebody with a button on their desk will push it, and the missiles start coming. That's, in my mind, far and away the biggest risk. So, are you going to have peace? Well, we're drifting away from peace right now. After 2 decades of drifting towards it, in the last few years we've been drifting away. That's not good. And those are the issues. And the geopolitics, the elections being discussed on primarily, nearly entirely, domestic political nonsense, excuse the editorial, and some real, and personalities. And the one thing that is happening that doesn't seem to show up in anything other than budget projections is military spending is starting up. And there was a fair amount of oomph behind it in both parties. Now that's going to have a domestic repercussion, but it vivifies the fact that we globalize everything that is considered a major plus or minus. And somebody shooting missiles at somebody else is a major minus. Disarray, breakdown of societies, the Middle East, is a minus. The biggie with the political scientists is the growth of the emerging power, political power, national power to challenge the big one. In other words, China's growth relative to the U.S. That comes to light in the South China Sea right now. Those are all issues that the next administration will have to deal with and will need support for. And those are the issues that concern me. And
So we've got time for, I think, one more question. Although I must say there are several very interesting questions here. And I'm wondering, before I ask you this last question, if you, I don't know how tight your schedule is, but if you have a few moments to stick around. If not, a little bit. Okay. So for those of you whose questions I didn't get to, you can race up to Dan and maybe you can address some of the ones that we're not going to get to. But I think we've got time for one more. And you made a point, and this is a question here in line with questions somebody's asking. You made a point that the Fed really is now in a position where they are having to be the fiscal, the owner of fiscal policy, and because our legislators certainly not doing it, in addition to monetary policy. So they've got a tall order ahead of time, and arguably it's a pretty difficult position to be in. Not just our central bank, but I think many of the others.
yes.
But we'll keep it to the Fed. So you've now been appointed to advise them. What are you going to tell them?
Do you have any ad? The Fed's between one rock and 4 hard places. 2 you just enumerated. Their principal risk they can't address openly or overtly because they have a domestic mandate. Fed's created by the Congress. The mandate is domestic, and they're dealing with international pressures. Bank of Japan's a bit more flexible. They're helping out with their bilateral swap lines in Southeast Asia. That has clearly helped. The European Central Bank is quite flexible too in that area, not so much domestically. And UK and Switzerland are smaller. But Bank of China, which is coming in as a major reserve currency, apparently, has decided they'll be the center of gravity for Southeast Asia. And right now, Bank of Japan is supplying the liquidity. So here the Fed is looking at all this with the domestic pressure to get the short rate up. And they're now, I think one thing that will be inferred tomorrow will be the first gentle talk about Operation Twist again. Let's let short rates go up and then hold the curve like that. The last time it didn't work. It might work this time. But they're just, the one benefit that the Fed has, it brings a big liability to it. The liability is that the staff people in Washington are all joining Weight Watchers because their interplay with the State Department has become so strong. And they both have, they each have the best dining rooms in Washington. So they get together and talk. Our domestic central bank, domestic mandate, is dealing with their major problems are international. And the flow of funds around the world is part of it. The other part they can't do anything at all about. The Fed has no impact on anything happening in the Middle East. They have no impact in Eastern Europe. They do have impact in the South China Sea. But that's what they're faced with. So, Jim, I actually do pray a bit at night. You used to be for grandchildren, before that, the kids. Great-grandson's he's all right for the moment. So I switched over to people who I really admire or feel sorry for. And after Sunday, Bill Belichick. But the people in the senior leadership positions, and particularly the central bank, particularly the State Department. It's controversial, but I'm one of those that think John Kerry should be sanctified. Other people would punch me in the nose for that. I mean, the pressures that those people are under are immense. Now, I don't think I answered your question very directly, but those are the concerns for the central bank. And God bless them. They got to do whatever they can do with their limited powers. And
So maybe the advice is keep playing.
oh yeah,
That's what you're gonna tell them.
yeah. And lay off the ice cream.
Well, it is now just 1 minute away from 1:30. Dan, I just want to use that time to thank you very much for coming out here. I know that it's a little more chilly out here than it is back home. But we don't have as much of that white stuff on the ground, but we are so appreciative of your coming out. And we think that we will be able to entice you to continue to come out because we really enjoy these conversations.
Well, when I talk to home, now 6-7 inches is not bad. I talked to one of my sons, and he and his family lived down on the coast down in Plymouth. They had a foot of heavy wet. He asked where I was, and I said, well, I'm not in Boston. I didn't want to elaborate.
Laura, have I forgotten anything before we adjourn the meeting? And Laura, by the way, thank you for, this is the lady that makes all of this happen and makes it run so smoothly. So thank you very much for your helping pull this together. And Dan, thank you. And the meeting is adjourned. Thank you all for coming.